Understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. It's time.
Hello, happy Friday. Welcome to another episode of the Tech Behind FinTech. Really exciting today. I have a guest. She was on the show previously. She's officially a friend of the show when it's your second time. Hoda Mehr, CEO of StockCard.io. Hoda, welcome to the show again.
Thank you. I'm excited to be back.
I'm excited to have you. There's a lot going on in the world of finance and banking, and I want to understand it, and I want you to help me and our audience understand it. Although she's a friend of the show, we still have to go over her bio for those that are seeing her for the first time. So let me get into it. Hoda Mehr is the founder and CEO of StockCard. Hoda has lived and worked in several countries and cultures, including the Middle East, Canada, and the US. She's an economist and has an MBA from the John Molson School of Business. Before starting StockCard, Hoda worked on bringing to market several multi-million software products. She has turned her side passion for investing and launched StockCard to solve the problems she discovered while running a 30,000 member private community of the stock market investors on Facebook. Hoda lives in Southern California with her husband and puppy Rottweiler. On social media, Hoda talks about the future of retail investing, the pursuit of 100-bagger investments, and her journey in building StockCard. Hoda, welcome once again.
Thank you. It's exciting. Today's conversation is going to be all going back to my root as economist. So I'm excited about that. That's always quite different than my day-to-day, which is all stock market. But today is all about economy and that kind of stuff. So excited to do it.
I love it. Let's just go over a few housekeeping things. Obviously, this is the Tech Behind FinTech. We're streaming live from Facebook, LinkedIn, YouTube, Twitch. We also have a separate feed going from our Instagram. The Instagram followers, if you want to be part of the show, you can go to the Tech Behind FinTech and click on one of our links to the episode on YouTube and LinkedIn. You can still ask your questions. You just won't be posted on the video. Everyone else on the platforms of Facebook, LinkedIn, and YouTube, you post your question. I'll add it to the show. Do our best to answer it. And so questions, or if you have some insight that you want to give, that's great also. So without further ado, today's topic is financial exodus, examining the reasons behind money exiting U.S. banks. So we're going to really dive into that. And that's what's going on. I mean, usually we go over a current news event, but this is current news because it's happening right now. So we're just going to jump into the topic. What we saw, I got the number, and these numbers go back and forth, but I read that more than half a trillion has left U.S. banks. Not necessarily meaning it left the U.S. because they go to other alternative investments, but U.S. banks, primarily a lot of the small banks and so forth. Hoda, give me your thoughts on that.
Yeah, it's we've seen this, as you call it, exodus of deposits out of U.S. banks happening in the past couple of months. But obviously, everybody heard about Silicon Valley Bank, which just started this whole sort of like brought it to the attention of everyone. But it's not a thing that is happening just in the past couple of months. It's actually much bigger than that. So I was reading some analysts from JP Morgan Chase. They basically estimated top 25 banks in the US have lost almost $1 trillion in their deposits in the past year. So it's basically a bigger problem than what we've seen happening with SVB or First Republic and a few other smaller banks. But it's just a general trend is happening in the US banking, and we will go through some of the reasons behind it, but it's in the past basically a year or so it's been happening.
So I mean that you know that brings the question. I mean, one of the things though that it took me while in this business, I learned, right? Like you would think, you know, it's all about deposits. Banks have all these deposits. They're bringing, but that's actually a liability to a bank, right? The deposits. Can you explain that?
Yeah. So banks have very interesting business model, right? Banks basically, by nature of their business model, they receive money from people in form of deposits, and then they do things with it, right? They basically multiply that money by loaning that money to somebody else, right? Or by investing that money into projects. So banks, by the nature of their business, it's an interesting business because the amount of money that comes in, this is other people's money. They're always liable to return that money back to people who put their deposits. But in reality, they never keep all of that money, right? So based on the regulatory requirements in the US, banks only need to keep 10% of the deposits that are coming into their system. They keep it as cash in basically the vaults or in Federal Reserve bank accounts, so that they can pay back to people who gave their deposits. Everything else, 90% of that cash, basically gets multiplied and put to work into the economy. And basically banks are in the business of multiplying the money that everybody puts in it. So to your point of they're always liable, is that 90% of the money that they are liable to other people, they never have it. They don't have it available. And just understanding that sort of explains why if more than 10% of people start wanting to have their deposit backs, it becomes a problem for the bank itself, because their business model is built on the foundation of this multiplying effect of money.
And I mean that's a good point you made, especially with the 10% reserves. I mean, so now in understanding that 10%, when we saw some of these banks get it going under pressure, a lot of withdrawals and things of that nature, were they at risk of going below that 10%?
Yeah, basically. So every bank that has gone under in the past couple of months have had different reasons for people panicking, basically, and wanting their money back. And we can go through some of those reasons behind it. But fundamentally, whatever the reason behind it was, the result for the bank was more people wanted their deposit back. And that resulted into the bank trying to basically finding a way to be able to pay back that deposit. So in case of Silicon Valley Bank, basically just a very large volume of people in a matter of that Thursday and then the subsequent Friday that the news was breaking out about Silicon Valley. Significant amount, so for something around like $40 billion in the first day and another something $80 billion on the second day. Basically, people wanted their deposits back because they were worried that the bank that won't have their deposit. So that was way above the 10% that any bank is available to basically pay back their customers, their liabilities. In case of something like First Republic, it was a different cause. It was because basically First Republic serve very high net worth individuals, and they basically get their mortgages. A lot of like high net worth mortgages was held by or was given by First Republic, or a lot of high net worth people were keeping their cash in the bank. And what happened is that everybody obviously knows that as the interest rate in the country went up, people who had their deposits at First Republic were asking First Republic, can we get more than like 0.5% that you're paying us, or tiny amount of interest that you're giving us, because there's better options out there. And First Republic realized this is not good for their business model, obviously, right? They can match what's the interest rate that is available out there, like 4%, 5% out there. And then when people realized First Republic is not going to give them that kind of interest rate, they started pulling out their money. So we can go through all the other banks as well, but every basically the trigger behind each of the banks was different, but the effect of it was that people wanted their money back, and they were able to pull their money back enough out of that bank that caused balance sheet problem, and basically the bank wasn't able to address those liabilities.
We have a comment coming in. I'm just gonna post the first question. It's one of our viewers, Mashik Samso. What about Signature Bank, where I work now? It was about shutting down crypto while others did not lose money.
Well, yeah. So I think you were working there, so you must have a lot better input from and inside compared to us. But to your point, the Signature Bank had again another cause, but the resulting impact on the bank was that it wouldn't be able to continue its operations. So every bank has a different trigger, but at the end of the day, it's their business model that won't hold true in this context. Obviously, the person who asked, I didn't see his name, but please chime in if there are other other aspects specific to Signature Bank.
Mashik. The thing when you mentioned First Republic, the thing that I found interesting about them, we talked about them. I talked about them last week. Even they have a lot of high net worth mortgages and so forth like that. And when JP Morgan obviously purchased them, but when looking at the books, not one of their mortgages, they had like 0%. Were over 90 days late. So, it's I just found that interesting, right? That the thing that they actually, the assets that they actually have. I mean, the liabilities, which are deposits, but the actual products they sell, the mortgages to these jumbo mortgages, not one was 0 day over 90 days late. But the main factor was, on there was like the massive amounts of withdrawals they had to cover, and then all the like 11 banks had to input 30 billion, and the Fed stepped in and so forth like that. So I just always found that interested in this process.
Yeah, it is very interesting because none of these banks that are going under, they're bad banks from a point of view of, oh, they're basically their customers are not good, or they have some, to your point, they didn't have any lots of delinquent, like they didn't create bad mortgages, which was like a 2008 problem. It's not that. It's basically the inherent risk that exists in the banking business model, and for someone like Chase, they still have the same business model, but someone like Chase has just so much presence in the U.S. economy. Like 10% of deposits in the United States, I believe, sits in JP Morgan Chase, and they have just such a diversified business model and such a big exposure to so many different banking products that they don't get impacted as some of the smaller banks like SVB or First Republic or a few other ones, or Signature Bank. These guys still have the same business model, but they're very inflexible. So they have the same risk as any other bank from a business model point of view. Their business model is reliant on the fact that you bring deposit and then you use 90% of it to do things, so you don't have that cash available. But they basically don't have they don't have enough optionality, or they don't have enough diversification in terms of business. They're just First Republic is so focused on one group of customers, which is high net worth individuals who want bigger yields always for their money. You have Silicon Valley Bank that is just so high concentrated on startups that they needed their cash because of what was happening in funding, VC funding ecosystem. So there was not enough funding coming in. Therefore, people wanted their cash more than what would typically bank expect. So when these four things happen, when your business model is inherently risky, it's based on the liability that you were just talking about at the beginning. You don't have flexibility in terms of customers. You are too focused on one specific group of customers, and basically you deal, obviously we can't forget about the impact of interest rates. So you deal with this external factor which is interest rate, and changes the expectation of your customers and changes the yield you can get on your previous investments that you've made when the interest rates were so much lower. So when you have these four factors coming together, these smaller banks won't be able to hold, right? Every bank basically in the world, or at least in the United States, with the structure we have, has these risks and has these problems. It's just that some of the bigger banks can tolerate it a lot more easier because they have such solid and such diversified businesses. The smaller banks can't because for the reasons we discussed.
It's real interesting. I want to pull up a stat if I can see this. I got this from last year, and it was let's see if I can just get it a little bit bigger so I can see it actually. It shows it was really the total deposits in the U.S. banks up until December 2022. So we go back all the way to the beginning of this particular chart. I think it was 2010. We see 9.274 trillion, right?
Yeah.
Things jump up dramatically. We hit a high point September 30th, 2021, 19.17 trillion. It goes up, and then things start going down. They didn't have data for this year, but I just found the whole thing interesting. I never, up until researching for the show, I never really knew the total deposits in the U.S. or even saw that from 2010 in the last 12 years, we have went up 10 trillion, right? Close to now we're over 10 trillion, and now we're coming down.
Yeah.
So,
what
do you make of these numbers? Because this is my first time actually looking at it or researching it.
Yeah. Well, it goes back to some of the foundational things in macroeconomic, basically, system of any country. So you've probably heard in the past decade, I mean, excluding this time that the interest rate is now up in the past year, but in the past decade or so, post the financial crisis in 2008, the US has been increasing what they call money supply, and then what they call money velocity. So money supply and money velocity is when basically during COVID, everybody got a check to support them to go through the COVID pandemic, right? Or when the Federal Reserve was reducing the interest rate. So forget about this last year, but since between 2008 and the last year, the interest rate was constantly was coming down. When this happens, you increase the velocity of money because people basically take their money out of storing it in savings accounts or in money market funds, and then put it back into the system, invest it because they want higher yields. They basically put it into different projects. So the money gets circled in the economy. So when and then obviously you have the government who issues more money because they need that money to be able to run the economy. So in the past decade or so, excluding the past year, when you see the deposits increase, it's because the economy is going through this expansion cycle of increasing the supply of the money in the economy and the velocity of, and velocity is what we were talking about at the beginning, the multiplier effect of banking system. You put $1,000 in the bank get 900 of that and put that into the economy, loan it back to somebody else, and that person buys something with that 900 and then put that what they earn, put it back into the banking system, and again the bank picks up 90% of that. So $1,000 that you put in the banking system, if it doesn't stay in that bank and it gets reinvested in the economy, has the potential to create $10,000 of money supply. The velocity of money is increasing. So that's why you see that increase in deposits and the money available in the economy. And when you start increasing the interest rate or the economy changes direction, it's the reverse of that happens, right? So interest rate goes up, people don't have as much they don't chase yield anymore, but trying to invest in the startups or invest in different projects, they actually feel, okay, I can put this money risk-free, almost risk-free, in a U.S. Treasury, or almost risk-free in a mutual fund that is focused on a U.S. government bonds, and it's almost risk-free, and you get 4 or 5% of it, and that results into reducing the velocity of the money and also reducing the deposits that go into the bank, because you don't want to keep that money in the bank. You want to put it in safer investments. So that's what's happening. Basically, economy was sort of like dealing with the aftermath of financial crisis, and it was in expansion mode. Money supply and money velocity increased, deposits increased, and then when the interest rate started to going up really drastically in the last year, we just saw the reverse of it. But it took a decade to expand the money supply and deposits in the banking, but this increase in interest rate was just so drastic in the last year that now it's like rapidly shrinking. It's going through the same motion, the reverse motion, but in a much faster speed, because the interest rate is going up much faster.
We have that's great. Thanks for that. We have a couple of comments from the audience. Stanley Butchlam, he's a former guest on the show. We were talking a few weeks ago. Yes, that was the result of negative interest situation where banks charge a depositor instead of paying them in order to take their deposit. So his comment.
Yeah,
Got another. You said, excuse me, Hoda?
I'm saying that's a good point. Yeah, he's got a point. When you get into the negative interest rate, that also, which we had for a while, especially in Europe, that obviously has a reverse impact on deposits.
We have another comment from Ashik again. Let's go. People save money, but government prefers inflation to perpetuate the market. Crypto is not under the government control and poses a threat to their strategy. You know what? And in switching threads right now, I'm just going to take a moment outside of this particular topic. One of the things in Tech Behind FinTech, we support the FinTech community, and we have started offering free profiles to certain FinTechs. So we're going to go over one right now and then get back to our show. So one of the free profiles this week of a featured company is Searchia. Searchia cuts out the intermediaries which prevent participants from financially protecting themselves. Searchia does this by standardizing contracts protected against climate and event risk and executing them automatically, thereby providing a direct risk transfer, helping to minimize the protection and pension gap. Why? Searchia, they are the first and most direct risk transfer platform. Their CTO, Tariq Sassy, sent this in, and we just wanted to profile that. Now, back to our topic, Hoda. So, the main thing we've seen, some numbers are saying $500 billion, $1 trillion have left. Where's the money now going? Heard some things about treasuries, some things about other things. Does it go into other countries? What's happening?
Yeah, I mean, the money is going after yield, right? So before, if you had money in the bank, you would get paid less than 1%. This is about a year ago, right? And you had no other safe place to put your money to get any yield higher than that, right? So that's why a lot of money was going to the stock market or going to startups and going basically chasing yield. The crypto creating a lot of higher yield than other options. Now that there is an option, now as the Federal Reserve increased basically the benchmark Fed rate, you would be able to get your money out of your bank or out of your other investments in startups and crypto and everything else, hedge funds, and then put it into, let's say, a Vanguard, federal money market fund. So a fund like that, it's not 100% risk-free, but it's basically U.S. government backing this fund. And what basically happens is that people, and you could get like a 5%, almost 5% annualized yield on that money. So why would anyone keep money in a banking system or even invest it in a market when you have the high risk of volatility in the market, where instead of basically putting your money in a money market or invest in a treasury, almost risk-free or totally risk-free, and get 4 or 5% annualized rate of return. And that's what's basically happening. I haven't seen a lot of evidence around money moving out of the US, but what I've seen is a lot of money moving into just safe or almost safe investments that have really good solid yield. If you think about it, if you keep your money in a startup or if you keep your money in the stock market and you're targeting maybe 10% yield, but you also have a high likelihood of volatility, versus almost risk-free 5% guaranteed return, a lot of people basically go with that almost safe 5% return. It's just math, it's just a safe investment versus taking risk. And that's what's happening. And a lot of people are basically just parking their money in safer investment opportunities out there. They're getting their money out of the banking system, which is actually not good for the economy, right? Because you're reducing the velocity of the money, and the result would be the banks cannot loan to the company, so you're not creating as much economic activity, and the money is just getting parked in safe investment, so it's not going back. So it's basically not good for banks and not good for the economy, but everybody's maximizing their own personal return, right? So you would obviously expect people to chase that higher, safer yield.
And you answered a follow-up question. You preemptively answered it, but that's what's going to ask. It's just like, all right, in terms of money leaving the banking system, it's not some weird conspiracy theories. Like, look, people just want to make more money on their money. Like, they're chasing yield. Totally understandable. And that was going to be the follow-up question. Like, what are the long-term overall macro impacts to this situation, right? They get the money out, banks have less. That 90% that they were trying to basically, in simple words, flip, right? They can't anymore. Now the economy starts to take an impact because now businesses can't get loans to expand. And I think this is something that the Sheikh said, perfect 2 words, right? Vicious circle. What happens?
Yeah. But if you really zoom out, no economy in the world, economy is basically a cyclical beast. You could never have ever you can't always expand, right? Because when you expand, the natural forces in the economy results into it will bring back the forces required to basically shrink. So I know it feels very scary, and obviously it is scary from an economic point of view. Like in the next year, next couple of years, we're going to see shrinkage of the economy and economic activity, and obviously there's a lot of side effects on people's emotions and sentiment, and we didn't talk about the impact on people's sentiment, which plays a very, very important role in all this, because when you hear the banks don't give you a loan and then money is moving out and people are scared about their deposit and all that good stuff or bad stuff, you also get very scared, and then you do less and you try to go in a protective and defensive zone with your own money and in your own economic activity. So it has this depressing effect on everyone. But in reality, if you zoom out, this is just an economy. This is the nature of the beast. It goes through these cycles. Sometimes cycles are really, really long, and sometimes cycles are very short, like what's happening in the past year. So I'm not defending Fed, or I'm not, arguing against or pro them. But what I'm just saying is that the economy can't always keep expanding. You have to constantly, it will always get expanded, and then the forces of the market will make it shrink. So hopefully hopefully the impact on this cycle is that what they call soft landing, and a soft landing is that you don't get a significant drop in unemployment, or you can control the inflation, and you don't get tons of money fleeing out of the system, and it becomes soft landing. But yeah, at the end of the day, it's just a cycle. I mean, as long as the economy has existed, there's always these cycles. Sometimes cycles are micro, sometimes cycles are really big, and that's what's basically happening in the US right now.
To like switch it back, right, about the chasing yield, I want to get your thoughts on Apple, right? Red started a new program in which they're giving what, like 4% or something like that,
Yeah.
to their savings situation. Can you like?
Yeah.
I'm curious, right? Like Apple, what if other big tech firms take this? It's almost, what's the incentive for me to have my money in a bank versus from a consumer perspective, right? They're giving more. Apple's pretty safe. I think the money is somewhat insured. What are your thoughts?
Well, if you think about it, all these big tech banks, tech have wanted to become a bank, right? For years. Google or Alphabet has applied for a banking license a couple of years ago. Apple obviously has had a strategy of becoming a bank. Everybody wants to become a bank or has been wanting to become a bank. And for something like Apple, it's the perfect opportunity, right? If your Chase bank account still give you less than 1%, and you provide 4%, we already have seen proof of it out there that people move their money because they want to chase that yield. So that strategy makes a lot of sense. I don't know in terms of specific to the Apple's banking system and what's happening in their bank environment, but from a consumer point of view, it just makes sense, right? And for Apple, this is a really interesting strategy and opportunistic move, because they basically just saw the proof that people would move their money. They wanted to always become the big bank for their customers as a part of their services strategy. So this is just a good incentive for them to move the money. So you will see all these regional banks, not all, but it's an interesting thing that seeing traditional regional banks may not be able to hold their deposits, but the big techs that have the cash from other businesses and have flexibility to be able to sort of fund this, they can basically just bring a lot of the deposits to their ecosystem.
It's going to be interesting how that plays out in the future, and then the impacts it'll have on it. Because you're always going to have the JP Morgan Chases of the world. Those are literally too big to fail, right? But how does it play out for the smaller regional banks and things of that nature as we move forward? So I find that very interesting. Closing thoughts on this topic, Hoda?
Yeah, I think it's basically, I always kind of try to step back in these situations and kind of try to put my logical hat on my head and just try to not panic myself. So I think it's interesting to see a lot of it's not interesting. It's scary to see a lot of scary topic headlines in the news, and we should always have this in our mind that this is the cycle of economy, and obviously news is out there to create emotions. And so my really closing thought is that things are never as scary as the headlines show, and it would basically, we've always survived through these cycles. If you think about the U.S. economy cycle, so we will survive and we will go through it. And this time, obviously, there's just so many players in it, and there's so many interest in not letting the situation get out of hand. So that's sort of it. It's just managing our own sentiment and trying to not get impacted by all the gloomy headlines out there.
Hoda, thank you very, very much for your time. Thank you for the information that you brought forth today. and helping us understand things better on the overall system and the economy, answering the questions from the audience and so forth. As always, we really, really appreciate you as a guest to the show. Can you tell the audience how to find you? And you could also talk a little bit about StockCard.
Yeah, absolutely. Thank you for having me. It's always exciting to come back and have a chat with you. Obviously, if you invest in the stock market, please visit a StockCard, stockcard.io. And our goal is we basically serve fundamental long-term investors, and we help them make more confident investment decisions faster. So if you are a long-term investor and if you want to do your research better, stockcard.io. If you want to chat with me, I'm on Twitter at Hoda Mehr. And my email is hoda@stockcard.io if you want to chat more about these things. So feel free to connect and chat.
Thank you very much, Hoda. Today's episode was sponsored by Strategic Generation, offering cybersecurity, penetration, and SOC 2 services. Strategic Generation is a sponsor of our show. Below in all our show notes, if you want to book an appointment to ask questions about pen testing, cybersecurity, and so forth, please feel free to do so. You can find them at strategicgeneration.com. So we have an audience question. Everybody's saying thank you, and someone asked, "Do you play the guitar?"
I try to. This is I'm trying to learn. Yes.
Yes, she does. Yes, she does. Awesome. Okay, so sometimes people might think it's a prop, but the fact that you actually I used to have one, and I just ended up giving it to my daughter. I gave up on it and just gave it to her.
Yeah, I try to. It's my sort of trying to, every time learning, I love learning new things. So this is part of my learning some new skills. And I try to. I'm not really good at it, but hopefully maybe the next time I come back, I play some song for you guys.
You know what? We might even close out on a song that you play next time.
Maybe, yes.
Listen, thank you very much for your time today. To our viewers, thank you very much to Stanley and Mashik asking all the questions, giving your comments. Thank you for that. Really appreciate the feedback and the interaction. With that said, I wish all of you a great weekend, and to all the mothers this weekend, have a happy Mother's Day. We are out. Cheers.
Understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. It's time.